I'd like to also understand the levels of debt and equity that are involved in a particular kind of deal. So you hear terms like, senior debt, subordinated, all that kind of stuff. Where does that fit into, I guess, how non-bank lending operates, and maybe a comparison between that and like Big Four funding? Is there a difference? Or?
So look, I guess that there is a word that sort of is used, a bit of jargon. It's called capital stack. So the capital stack is basically, if you imagine total development costs for a project. So when I say total development, I'm talking about from the purchase of the site right down to the interest charged on the debt, finance costs, council fees, you name it, everything. If you were going to do a profit and loss statement, this would be all of your expenses, right? So when you look at that, that's all going to get paid for, all right? Now, how that's paid for is usually made up by the capital stack. So typically in senior debt, what they call senior debt, that refers to the first mortgage holder, so the main funder. So when people lend against a security property, you always have what they call a first mortgage holder, and sometimes you might have what they call a second mortgage or mezzanine debt, which comes after that, or junior debt, it's also referred to as. So they would come second. All that means is, if this property's got to get sold to recoup money, the person ranked first gets their money first. Person ranked second will get a second. So obviously the senior debt or first mortgage holder usually provides the bulk of the capital. So in construction finance, that's typically up to 75% with a bank of those costs. And in the non-bank space, you can usually go up to 80%. Now, some will allow you to go higher, but it's typically 80% of that. So that means, let's focus on the non-bank space for now. So if a lender is going to lend you 80% of those costs, that means that the developer has to put in 20%. So they have to cover 20% of those costs. Now, typically that will be all the stuff that happens in the early stages.
Planning,
marketing, those sort of things, council fees, the equity they've put into the site when they buy it. So when it comes time to doing the construction and drawing down on the construction loan, if there is any equity that's still got to go in, it'll go in from the developer then, and it'll usually go in to the land. If anything has to be contributed, he'll put it into the land, and then once that's all done, then they'll start drawing down on the construction loan.
Okay.
Now, where that varies is sometimes a developer might not have 20% cash equity. So they've put in as much equity as they have upfront into the land, and maybe they've paid for a little bit of planning, but they've got no more money. And there's still a gap. Let's say they've only been able to put in 10%. So now there's a 10% gap between that 80, they've put in 10, and now there's 10% gap that needs to be filled. That 10% gap is usually filled by what they call a mezzanine loan or a junior debt. So there is lenders out there that will go as a second mortgage. So essentially the developer puts in their equity, then the mezzanine lender will put in their 10%, so it'll act as a loan to the developer. And then once that's put in, then the first mortgage holder, the senior debt, will put in theirs.
But they won't necessarily, the senior lender won't necessarily put in their money up until...
They won't put it in until the first two have.
The first two have, okay.
That's right. So, yeah.
But it's the opposite way around.
The opposite way. So,
when you're taking it
that's
out.
Right.
Is that right?
So
yeah.
Money goes in first by the developer, second by the mezzanine lender, and third by the junior debt, and it flows out the opposite way.
The opposite way, yeah.
The main lender gets their money back first, the junior lender gets their money back second, and the developer gets their money back.
The poor developer.